So we looked at this diagram as a way of summarizing all the different sources of finance, but now we're going to focus on the external ones. Now the external sources are from outside the business. So it could be banks, it could be shareholders, it could be private equity firms. There are all different ways of getting money from outside the business. Some of them involve, inviting new owners in. Some of them just involve borrowing and you pay it back and the relationship is over. But we're going to focus first on external equity. So ordinary shares and private equity. The advantages of using equity, external equity, not internal equity like retained profits, but the advantages of using external equity are firstly, obviously, it doesn't add to the debt levels of the business, and there's also no interest payments because you're not actually getting a loan. So those are the general advantages, but the general disadvantages, obviously, if you're inviting new owners into the company especially, the ownership gets diluted, and we look at that a little bit in more detail when it comes to new issues, because the existing shareholders end up having to share the profits with more owners, which means that they get less each. So they have to be very, very careful. There's also often a change of ownership structure, especially with private equity firms. You need to be very, very careful that they come in with a huge amount of money and they say, right, we're going to do this and this and this and this. Just give us, 51% of the company and that's fine. But then they end up selling it all. Right? So the change in ownership structure also changes how much you control the business. So really you have to give up some level of control, which for some businesses is a deal breaker. They don't want to give up that control, and so they don't get the money. When it comes to the equity sources, the first one is ordinary shares. Now, just when you're writing shares, just write ordinary shares. You don't need to know the not ordinary or the weird shares or the bizarre shares. So they're preference shares. But just write ordinary shares in front of it. It's something that can make you sound smarter, because you're going, oh, well, it's not just I know more about shares than anyone else because I call them ordinary shares as opposed to the other type, which are preference shares, which you don't really need to know about because it's not in the syllabus. But the ordinary shares are when investors pay the business money for a couple of things. You get a couple of things in return. Firstly, you get a share of ownership. That's why it's called a share. You also get to share the profits through dividend payments. But the risk there is, firstly, the business might not make a profit, right? The other risk is the owners might make a profit, but then decide to reinvest the profits rather than sharing them. So you do have that risk. It's not common, even though, well, I went through the example of Apple before, retaining their profits all the time, and eventually, having a dividend. But the owners may decide to reinvest it, and that, even though it's not completely common, it does happen. And it happened a lot during the global financial crisis when businesses were starting to panic and they went, look, we can't just go handing out money to all our shareholders, and they'll understand that we need the money, in case something, terrible happens. We're going to need that money, and once you've already given it to the shareholders, they're not going to give it back, right? They're just going to spend it. The other thing that you get is the right to vote on large things. So like annual general meetings, and you see them sometimes on the news, usually like NRMA, they have their big annual general meeting and all the board of directors gets up on the stage and people, yell things at them and blah, blah, blah. But you do get voting rights, but only according to the number of shares that you have. So in reality, you don't really get voting rights. If you or your parents have like 1,000 shares and whatever, you do have voting rights, and you'll get little like brochures in the mail saying, oh, we're going to vote on the board of directors. We recommend that you vote this way, and you don't have to, right? But really, in reality, it's usually 5 to 10 owners really own 51% of the business. So they actually, if they all vote together, they control the business. And it could be, banks, or it could be, firms that actually have that ownership. So you don't really have those voting rights in reality unless you're a billionaire. The advantages of ordinary shares, obviously you don't have the interest payments because you're not borrowing money. And the other advantage is that even though you can share the future profits, you can give out dividends, you still have a choice. You can't do that with loan repayments, right? You can come to the end of the year, you make $1 billion profit, and you can actually keep it. You can decide, look, we have very good reasons we're not going to share it with our shareholders, and you can hold on to it as the business. You can retain those profits. You can't do that with loan repayments. You can't say, look, I'm going to retain my loan repayment this month. You just have to pay it, and you're stuck paying it. So you don't really have a choice if times are kind of bad. The disadvantages, obviously the process is pretty difficult. So say an IPO, an initial public offering, which we're going to look at in a sec, is very, very expensive. You've got to have a prospectus, blah, blah, blah. And it also takes longer than debt finance. Often you can get debt finance very, very quickly, especially if you have a good relationship with a bank or with a firm that can hook you up with it, like Macquarie Bank. There's also a risk that not enough people are going to buy them, and that problem is called undersubscription. So if you've looked at the example of Facebook, Facebook went public, they started selling shares in themselves, they overvalued their own shares, and people didn't want them. So the bank that was underwriting it, ended up copying it. But really, they had to buy all the shares. That's their problem. But that risk of undersubscription is also bad for the business. If you can't sell all your shares and someone has to buy them for you out of a legal obligation, they don't really want to, but they have to, then it looks bad for the business, and it looked very bad for Facebook. It gave investors, future investors, if they decided to sell more shares, it gave them a reason to not do it, to not give Facebook money, because there must have been a good reason why people didn't buy those shares, right? If you go into a shop and you go to buy something and it's covered in dust, you might go, wait a second, so no one else has bought that, so wait, why should I? There's also the disadvantage of the dilution of ownership. If you issue shares, then you've got more owners and you have to share your profits with more people. So your share of the profit is going to be lower. So those are the general advantages and disadvantages of ordinary shares. But the syllabus requires that you go into even more detail about ordinary shares. The ways of issuing ordinary shares are also covered in the syllabus. You've got those 4 different ways: new issues, rights issues, placements, share purchase plans. Really, the new issues one is the one that you probably already understand, and anyone would really understand, if they have a basic grasp of it. But the other types are a little bit different, and you do need to know the difference between them, because especially for a multiple choice question, if you're asked, which one of these describes a rights issue, then you do need to know which one is which. So we're going to go through each one, kind of briefly, and some of the issues with them. For new issues, at first it's done by an initial public offering. So often you hear the phrase IPO, and a lot of technology companies right now are doing this sort of thing, like they did, back before the original, bubble burst, the tech bubble burst back in around 2000. They do it through an IPO. The idea is that you have to issue a prospectus, which is like a book of everything you need to know about our business. And you need to be very honest in that, because if you don't, there can be some punishments. If you say, oh, our business is fine and there's no problems and blah, 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 but you did know about issues and the company goes belly up, they're going to look at your prospectus and say, look, did you lie to those investors? Or did you come forward and say, look, these are the issues? So when Facebook did their IPO, within there, they had to list all the different, it was like 30, 40 different reasons why you probably shouldn't buy shares in Facebook. And one of them was Facebook doesn't really have a good history of making money from mobile devices. And that was kind of an understatement that they getting into a little bit of trouble with. But that prospectus, that book, that list of things about the business is very, very important and legally required in Australia. You also need to then go and sell those shares on the Australian Stock Exchange, or the Australian Securities Exchange. So that share selling process is done through them. The advantages of an IPO, if it's successful, you get the largest amount of funds. It is very, very difficult to make any more money in any other way than through an IPO. You can make billions through an IPO, through a successful IPO. The other advantage is that if you get it underwritten, it's fairly safe. So you go to a business, usually like a bank, and you say, hey, we're going to have this initial public offering. We're going to sell 100 million shares at $10 each to raise $1 billion. But we want you to buy any shares that no one else wants to buy. And you pay money for that. And then it's in the bank's best interest to promote the hell out of this IPO, because they don't want to be stuck buying the shares in the end. So, that's the advantage of underwriting. It makes it pretty safe for the business, right? It does cost, a bit of money, obviously, but it makes it fairly safe. The disadvantage, obviously, it takes a long time. The whole process from start to finish can take a couple of years. And there's also that risk of undersubscription. Like I said, when Facebook, they were undersubscribed, not enough people wanted to buy the shares. Luckily, they had that advantage of being underwritten. So they had to buy those shares. The bank that underwrote it had to buy those shares. So that disadvantage can kind of be balanced by underwriting. The second type is the idea of a rights issue. This is after the initial public offering. The existing shareholders, not new shareholders, existing shareholders get to buy more shares at a special price, right? And that gets offered to them. The advantage is obviously it's cheaper than an IPO and it's faster than an IPO because you don't have to go through that whole process of, okay, we're going to have a prospectus, we're going to do this and that. You just send out to existing shareholders. You let them know, look, you're an existing shareholder. You understand the value of our business. Would you like to give us more money at this special price? No one else is going to be able to buy it at this special price. But you still get the same share, right? You still get the same share as someone, or the shares you originally bought. So you get a higher percentage of the profits of the business just by doing that. The disadvantage, though, is that special price. You're probably going to get a lower price and you're going to have less possible buyers because you're not inviting new shareholders in. If you have like another public offering and offer shares to everyone, you have the existing shareholders, they might like to buy some more. And you've also got new shareholders. But with a rights issue, it doesn't work that way. You're stuck with the owners that you've already got. Placements are private selling of shares, not through an IPO. The advantage is obviously it's cheaper and faster and easier because you're privately selling those shares to individuals. And if you're, say a private company, you're probably going to do this, right? You're not going to have an IPO because you might not want, every Tom, Dick and Harry, buying shares. I can't believe I just said Tom, Dick and Harry. I'm just so old. The idea of a placement is that you sell them privately to people that you specifically want. But that's not going to raise as much money as an IPO would. Like I said, an IPO is the best way of raising the largest amount of money through equity. The fourth way is a share purchase plan. What some shareholders do is they can choose to get shares instead of dividends. So this often happens, with the executives often get this. Rather than getting a dividend one year, where they say, all right, here's your $10 million dividend. The business can say, look, here's $10 million worth of shares. The advantage of doing that for the business is that it's quick and it's cheap and it really doesn't cost the business anything because they just say, right, here's 10 million more shares, right? They can just make it. They create them out of thin air. So it's quick and it's cheap. But the problem is you're probably going to do it at a lower price than offering new shares, which means you're not going to make as much money. But the good thing about it, the huge advantage and the reason that more and more businesses today are doing this, especially with their executives, is because they tell their executives, so say their chief financial officer, they say, look, how about we give you, instead of your $10 million dividend this year, we're going to give you $10 million worth of shares. The chief financial officer might go, okay, good, yep, I love $10 million worth of shares. It's not cash. You don't get that money straight away, so you're not getting money in the bank. But that chief financial officer or that executive or that employee is now going to work that much harder to make sure that the business's share price keeps going up because they want to eventually make more than 10, so 15, $20 million from that initial $10 million dividend that they had. So it can be a much easier way of making more money for them, and it's good for the business as well. The second type, other than shares, of equity sources is called private equity. So places that you might have heard of, like American places like Goldman Sachs, JP Morgan Chase, these are private equity firms. They are businesses whose job it is to buy other businesses, or part of them, right? Not the entire, other business. But they raise the money with, billionaires. They get billionaires together and they say, right, we as a business are going to buy another business. Do we really want to run the business? No, we don't want to run the business. JP Morgan Chase isn't really interested in, running, another business, bread shop or something like that. They're interested in buying the other business to make a profit out of it, right? The advantages for a business of getting private equity money is the enormous amount of money available. These people have almost unlimited funds. you can get an enormous amount of money from them, and it's much easier than an IPO. You don't have to do all that disclosure. You don't have to tell everyone all the ins and outs of your business. You only have to go to Goldman Sachs and say, look, hey, these are the ins and outs of our business. Would you like to give us money? Sometimes the investors even have good ideas for the business. If it's not necessarily one of those private equity firms which are kind of known for tearing businesses apart and selling them off bit by bit, sometimes you can get private equity from an individual investor, and that individual investor might have some really good ideas about running the business. The disadvantage, though, is that the original owners lose a lot of control. Often what these businesses do is they get like a startup, like a starting business, and they go, right, we're going to give you $10 million, but we want 51% of control of that business. You have really lost control of your invention or your business idea just to get that money. You've kind of sold your soul, but you've also sold the future rights to your business. And sometimes the private equity firms aren't even interested in growing your business. What they want to do is try to cut costs so that your business becomes more profitable, but maybe not the type of business that you would want, right? They might, want you to do unethical things, and it's really their decision because they're the ones that gave you the money. Or they can even shut down a business. What they do sometimes is they find a business that, say they need $10 million or something like that, and they say, look, hey, we'll give you the $10 million, you give us control of the business, we'd love to grow this business and expand it, and we're with your vision, and we love it, it's a great idea. And then the second that they have control, they go, right, this business is now shut down, we're going to sell off all the assets because we secretly valued all your assets, and they're probably worth about $20 million. So us paying $10 million for your $20 million worth of assets that we sell off is really worth our while. So it can be very, very dangerous, and they can do pretty nasty things to especially a smaller business. The external sources that are classified as being debt sources are all about borrowing. And in general, the advantages of borrowing, firstly, it doesn't change your ownership structure because you get the loan, you pay it back, and that's it. That's the end of the relationship. You don't have to pay them dividends for the rest of the life of the business. It's also faster and a lot more straightforward than an IPO. You really only have to talk to the bank or the firm or wherever you're getting the money from, rather than making all your details public. And there are also some tax advantages, especially with some of the short-term things. And long-term as well for leasing. Sometimes it's better for tax reasons to lease things rather than buy them outright. The disadvantages, though, are the interest payments. Now, the interest payments, depending on what type it is, they can be very, very high. They can, change very quickly, and you may not be able to cope with that. The second thing is that the payments need to be made on set dates. Unlike dividends, which you can kind of choose as long as you can kind of justify it. You can choose whether to pay the dividends out to the shareholders or not. You can't choose whether to pay the bank or not. It's compulsory. The other disadvantage is that security might also be required. So say you're getting a mortgage, you might have to sign over, the building or the factory or wherever you're doing the work, or the land that it's on, as security. You might have to sign it over to a bank. So they're going to use it as collateral. If you don't pay back your loan, you lose your entire business, right? Which is a pretty serious disadvantage. When it comes to debt sources of external money, the short-term borrowing means that you're going to repay it in less than 1 year. So short-term in this finance section means less than 1 year. For you, short-term might mean like 2 days, right? But in business studies, when you say short-term, it means less than a year, less than 12 months. And we're talking here about overdrafts, about commercial bills, and about factoring. Overdrafts are the first one, and they are short notice, short-term loans from a bank. Usually it's less than $100,000. It might only be, $5,000 to $10,000, especially if you're a small business. It's just enough money to tide you over, right? It's not going to help you, expand the business or anything like that. And it's really not a good idea to use it for that purpose anyway, because the interest rate is pretty high, right? But the good thing about it is that you can get it at short notice. That's the main advantage. You can get it, sometimes it's automatic. Sometimes, you just need quick phone call to the bank, and the bank automatically goes, yep, all right, fine, you can have an overdraft, $10,000, pay it back by this date, and away you go. You don't need to do the whole application process. It's also very flexible, depending on which bank you're with, and usually it's not secured against assets. So if you're not paying back if you don't meet your overdraft payments, chances are they're just going to say, look, you're not getting an overdraft in the future, not we're going to take your entire business, right? Because you haven't used the business as, the premises as collateral. The disadvantage, though, is it's a much higher interest rate, and it's usually variable, and quite quickly. So it can, change very quickly. So that higher interest rate is the price you pay for getting money quickly. And the bank, even though they usually don't, they can demand repayment at any time. If the bank feels like you're about to go under, they can say, right, we demand that you pay this overdraft now. And even though they usually don't, you do have to do it, right? Or you have to say, look, I've got nothing, right? I'm going to declare bankruptcy. So you do need to pay that back whenever the bank says. But 99% of the time, overdrafts just go smoothly, quickly, but it's really not a large amount of money that you're borrowing anyway, so you're not going to be able to do too much other than pay the bills with it. The second type is a commercial bill, which is a short-term loan, usually for larger amounts, right? So more than $100,000, and it's usually 7 to 180 days, so 6 months. So the short-term loan from a bank or non-bank financial institution, just write NBFI if you really want to. It makes you sound smarter anyway. The good thing to know is that only the interest is paid until the end. So in terms of your repayments, you don't pay back, say you borrow $1 million, you don't pay back that $1 million until the end of that 180 days. So you have all that time to get that money together. You do have to pay interest. You get like a certain, every certain amount of days, you have to pay an interest payment. But that really is up to the individual agreement. It's very, very flexible. In terms of the length of time, the amount of interest that you need to pay, it can be very, very flexible. So this is a good choice for businesses that need a larger amount of money, but they need it pretty quickly. Say they see some, big advantage or big opportunity that they can take advantage of now, but they need a larger amount of money. They can usually go, okay, well, we're just going to get a commercial bill. The disadvantage, though, is it's usually secured against assets. There is that also big payment at the end, but hopefully your business can handle it. But usually it is secured against assets. You need to know that you can lose, your business's assets, especially the land or the property, if you don't pay this back. The third type is factoring. Factoring is a little bit complicated. So if you go to a balance sheet, and the balance sheet, if you look at the other section about monitoring, a balance sheet kind of looks like that. You've got current assets, non-current assets, current liabilities, non-current liabilities, and you've got the equity right down the bottom, the total equity down the bottom on the right-hand side. When you have a business, you probably have accounts. Accounts are when money is owed, whether to you or by you. Accounts receivable are an asset that you have because it's when your money or your business is owed money by customers. So really, if someone owes you money, say your friend owes you money right now, and I'm sure you're picturing a friend who owes you money right now. If they owe you $10, you have an account receivable worth $10, right? You are owed that $10 from that person that borrowed it. But there is a problem. What if they're not paying on time? And what if you need that money now, right? What if you're saying, look, I need that money now. I need that $10 now. And they're just saying, look, mate, I just don't have it, right? The same thing goes with businesses. You might have an account receivable. You might have, a business that owes you money for work that you've done, or a customer who owes you money for work that you've done. But you need the money to pay your bills now, and they're just not paying. You've got a couple of options. You can go and break their legs, but that's kind of the Mount Druitt way of solving it. But another option, and a legal option, is to sell your accounts receivable to another business. The other business is called a debt factor, for a percentage of the total value. So what you might decide is, okay, I've got this $10,000 debt or account receivable that so and so owes me. They owe me $10,000. rather than chasing them and chasing them and chasing them and chasing them for that $10,000. What I can do, I can go to a business called a debt factor, basically a debt collector, and I can say to them, look, this guy owes me $10,000. I don't want to bother having to chase him for that $10,000. I need money now to pay my bills. How about you give me $8,000 right now, and I'll give you a piece of paper saying that you have the right to go and get the full $10,000 from that guy. So for them, that's a good deal. They pay $8,000 to you. You get the money right now, so you're happy. They get $10,000 for $8,000. All they have to do now is go and get that money. Right? They just have to go and get that money. And they are very, very good at it. They're incredibly efficient at doing that. That's their business. Getting money is their business, right? So if you haven't paid your phone bill, you might get a phone call from, Bay Corp or Charter Mutual, or Charter Mercantile, sorry. You might get a phone call from them saying, hey, look, you didn't pay your phone bill. You owe us that money. And you're like, no, 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 no. I didn't pay my phone bill to Optus. They'll say, no, no, no. Optus has sold that phone bill, that owing money, they've sold it to us. So your $500 phone bill that you didn't pay, Optus sold that for $400. And now this place is trying to get that $500 from you so that they can, get their money back. And they're going to get the whole amount, and they have all sorts of nasty ways of doing it. The advantages here are obviously for your business, you get the cash straight away. You also save on the time and effort chasing customers. So if you have to start threatening, like, oh, I'm going to get lawyers and stuff like that, eventually you're probably going to have to get lawyers because some people just aren't going to pay. There's always going to be a certain percentage of customers that, when trusted to pay, are not going to. So if you don't want that happening, then you might, be engaged in factoring. The problem is that you usually end up getting like 80% of what you were owed, which is bad because, for short-term gain, yeah, it's good. But over the year, if you're doing this a lot, if you're doing a lot of factoring, if you're selling a lot of your accounts receivable, you're missing out on money that you could have had. Something better that you might be able to do is just tell customers, look, no credit, right? I'm not going to start a tab with you. I'm not going to send you an invoice. We're going to request you to pay up front. You might lose customers, but at least the customers who you do have are going to pay up front. This has kind of been taken away a little bit by credit cards because people pay on credit cards and then you get that money a couple of days later, usually knowing banks, but you get that money from the credit card company, and then it's their job to go and chase the credit card money. So some places do that sort of thing. For long-term borrowing, which is obviously more than 1 year, don't ask me what a 12-month loan is, whether it's short-term or long-term, because usually I'd say it's short-term. I don't know. Just pick one. But less than a year is short-term. More than a year is long-term. These are things like mortgages, which, like I said, they pop into your head straight away when you think of long-term. But to get the extra marks, you've got to go into debentures, you've got to go into unsecured notes, and you've got to go into leasing, which doesn't automatically seem like a long-term borrowing. It doesn't seem like borrowing at all because you're not really borrowing money, you're borrowing stuff, right? So we're going to go into each of these. A mortgage is a large loan from a bank that's secured against the business's land or buildings. So that's supposed to be a factory there. Say that's a factory and you need a large amount of money, whether it's for the factory itself or whether it's to buy equipment from the factory. A mortgage can get you that money as long as you're willing to say, right, we bet you that we're going to pay it back. If we don't pay it back, you can take our building, you can take our business. The advantage here, especially for small, medium enterprises, is that you do have access to large amounts of money. So for a smaller business or a medium business, you probably don't have access to those large private equity firms or initial public offerings and things like that. So a mortgage is probably your best way of getting a large amount of money. The other good thing is that it kind of unlocks the value that the business has in its land or in its buildings. So the money can be used to grow the business. So if you want to fill that factory with new equipment, you can and say you originally bought the factory or you've already paid it off, you can then get another mortgage against the value of the building and then refill it with the latest equipment, right? So there's value that you have. You have a non-current asset there, and there's a lot of value in it, and you can unlock that to expand the business. The disadvantage is obviously the risk of foreclosure. If you don't meet those repayments, it might lead to you losing the entire business, and that's a pretty big disadvantage. Debentures are also large loans, and they're also secured against the business's assets, but the loans are from investors rather than from a bank. Um, but the right to collect that money, the debenture itself, is just a piece of paper, and that itself can be sold. So for you, I mean, it's not really something that you think about, but you won't necessarily be paying back the same people. But the main difference is that it is from investors rather than from a bank. Unsecured notes are also loans from investors, but they're not secured, right? So that's the difference there. They're not secured against a business's assets. The advantage is there, obviously no security is required, but the disadvantage is that because it's not secured, any loan that isn't secured, the interest rate is usually going to be higher because there's extra risk to the lender. They're more worried that they're not going to get their money back because in the end, they can't just sell your business or sell the business's assets to get that money back. The fourth type of long-term borrowing is leasing. So leasing is like renting. So you can lease your assets like equipment, buildings, things like that, instead of buying them. The advantage there, obviously there's tax advantages, which you just have to say. You don't need to know what the tax advantages are. It doesn't really matter what the tax advantages are. You just need to know that there are tax advantages for leasing. There are also tax advantages for borrowing as well. And it gives the business access to the property or equipment that they need without needing that lump sum payment. And that's going to free up money for other needs. So some businesses start off, we want to own our business premises. So they'll spend $1 million on, a shop, like the actual shop itself, when they could have just, leased it. They could have just rented it. Now, that's because they want to own it in the end, and you're never going to do it when you're leasing it. But by leasing, you get to have the things that you want now without having to pay the entire amount. The disadvantage, like I said, is that you don't own it in the end. So what you need to do is go, okay, do I think that this business is going to go on for the amount of time that it really would take for me to pay off a mortgage? Or should I just lease the property or lease the equipment? And the other thing, and something that you should have learned already over your lifetime, is that leasing or renting or borrowing is going to have a larger total cost over the time than if you paid up front. If you're a business that you think is going to be around forever, like BHP, then it's really not a problem. You're going to be around in 30, 40 years. But if you're a small business, if you're just starting out, you may think, all right, it's worth paying a little extra in the long run because we're not entirely sure that we're even going to get to the long run. So it's probably a good idea to try and expand the business now rather than trying to plan for 30 years down the line. So those are all the external sources of finance, and I know there are a lot, and you can just go through and write your study notes by skipping through the video if you want, without listening to it again.